Ladies and gentlemen, good evening and welcome to the ICICI Prudential Life Insurance Company Limited H1 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Bagchi, MD and CEO of ICICI Prudential Life Insurance. Thank you and over to you, sir.
Thank you very much. Good evening and welcome to the results call of ICICI Prudential Life Insurance Company for the half year ended September 30th, 2023. I have several of my senior colleagues with me on this call. Amit Palta, who heads Distribution, Brand, Marketing and Products. Dhiren Salian, our CFO. Jeet, who heads Human Resources, Customer Service and Operations. Deepak Kinger, who handles Audit, Legal Risk and Compliance. Manish Kumar, our Chief Investment Officer. Shobik, our Appointed Actuary. And Dheeraj Chugha, our Chief Investor Relations Officer. Let me take you through some of the key developments during the quarter before moving on to discuss our strategy and performance. First, on the regulatory front, as a step towards moving to RBC regime, IRDAI has directed insurers to undertake a quantitative impact study to assess the impact of the proposed framework for quantification of capital and solvency requirements following a risk-based approach. Additionally, with the objective of aligning India with global accounting standards, the regulator has notified the phased implementation of IFRS/Ind AS in the insurance sector starting April 2025. Second, a recent development in the fixed income market is the introduction of 50-year GSEC in the H2 FY 2024 borrowing calendar of the government, a long-standing demand particularly by life insurance companies. The introduction of these ultra-long-term bonds is a positive move for the entire industry. Third, we had our 23rd AGM through the video conference on July 28, 2023. All the items specified in the notice of the AGM were approved by the shareholders of the company. I'm also pleased to inform you that the members of the company have approved the item of special business pertaining to the appointment of Mr. Solmaz Altin as non-executive director nominated by Prudential Corporation Holding Limited with effect from August 22, 2023 in place of Mr. Benjamin Burma by way of an ordinary resolution through the postal ballot. Fourth, I would also like to share that ICRA and CRISIL domestic rating agencies have reaffirmed the long-standing rating of our subordinated debt program as ICRA AAA and CRISIL AAA respectively. The outlook on the long-term rating is given as stable by both these agencies. Lastly, I am happy to share that our company has received an award for the Best Sustainability Report from CMO Asia. Additionally, the company has also been bestowed with the Best Overall Sustainable Performance and Best Sustainability Report at the 10th edition of the National Awards for Excellence in CSR and Sustainability from World CSR Congress. I am also pleased to inform you that MSCI, a leader in ESG research and index provider, has upgraded our ESG rating to AA, which places us as a leader among the life insurers globally on ESG front. In fact, among all the listed insurance players, we have the highest ESG rating. FTSE Russell has also improved our ESG rating score, which is higher than the life insurance sector average. Lastly, Sustainalytics has retained our company as low-risk status, ranking us among the best among all Indian insurers. These awards and rating upgrades are a testimony of our commitment to the ESG practices. I will now move on to discuss the key performance snapshot for H1 2024 presented on slide 7. Our VNB for H1 2024 stood at 10.15 billion rupees with a margin of 28.8%. Our total APE at 35.23 billion rupees for H1 2024. Our market share based on RWRP has been increasing every month, growing from 5.2% in April 2023 to 6.3% in September 2023. In Q2 2024, multi-partnership channels have delivered a strong year-on-year growth with partnership distribution growing by 25.1% and Banca, excluding ICICI Bank, growing up to 13%. Direct channel has delivered 19.3% and agency channel grew by 4.2% year-on-year in Q2 2024. We have been investing in our agency channel over the past few quarters and we have started to see the benefit coming in our monthly business performance, where we have registered double-digit year-on-year growth except for the month of September 2023. In group business, credit life has continued to witness very strong growth in Q2 2024 as well. Group term business growth has been challenged due to decrease in rates post-COVID-19 and increased competitive pressures. We are among the largest players in this segment and understand it well, and will underwrite business only if it matches our risk-reward expectations. Our protection AP stood at 7.34 billion rupees in H1 2024. The retail protection AP witnessed strong growth of 73.7% year-on-year to rupees 2.38 billion in H1 2024. Our persistency improved significantly across cohorts. Our 13-month persistency stood at 86.9% and 49-month persistency stood at 65.8%. Our cost to TWRP for savings line of business stood at 17.2% in H1 2024. When we look at the H1 2024 performance, let me now talk about the strategy and framework adopted by the company. With the customer at the heart of everything that we do, our 4P strategic elements comprising of premium growth, protection business growth, persistency improvement, and productivity enhancement continue to play a crucial role in the growth of absolute VNB while we integrate ESG with business management. As detailed in Q1 2024 earnings call, to drive our 4P strategic elements, we have a 4D framework: data analytics, diversified proposition, digitalization, and depth in partnerships, with focus on quality business in a risk-calibrated manner. The framework has been presented on slide 5. The 4D framework ensures that the products are aligned with the customer needs, are developed with the highest quality standards, and are delivered through the most appropriate distribution channels. The aim is to provide simplified and hassle-free processes to our customers across the product lifecycle. In line with our 4D framework, we have recently launched first of its kind ICICI PruStack, a suite of platform capabilities encompassing digital tool and analytics to significantly enhance customers' lives and create a differentiated experience throughout their journey. The 7 layers of ICICI PruStack have been presented on slide 6. Right from identifying target segments, crafting value propositions as per the customer needs, building capabilities through digital and physical modes to serve the proposition, integrating partner ecosystems and sales processes to deliver a frictionless experience, to provide best pre- and post-sale services, our capabilities allow us to deliver value across the customer lifecycle. Our intent is to be the most customer-friendly and partnerable insurance for our distributors. And we have anchored our outcome focused on growth, quality, productivity around the 4D framework. I would also like to talk about claim settlement, which is really the moment of truth for any insurance company. I am pleased to inform you that ICICI Pru Life had a class-leading claim settlement ratio of 97.9% in Q1 2024. This is a strong testimony to our customer-first philosophy, which is ingrained in the business practices that we follow at ICICI Pru Life. I would like to reiterate that the entire 4D framework has been put in place by keeping in mind our core objective to deliver quality business in a risk-calibrated manner. Thank you. I'll now hand it over to Amit to take you through the updates on our 4D framework and our results on our 4P strategic elements, after which Dhiren will take you through the financial highlights. Over to you, Amit.
Thank you, Anup. Good evening, everyone. As Anup highlighted the strategic importance of our 4D framework in his opening remarks, let me highlight the key initiatives we are undertaking towards strengthening this framework. The first element is data analytics. Over the years, we have invested in data science, integrated insights from our own customer data with macroeconomic household data to develop deeper understanding of customers across life stage and income segments. The details of our extensive deployment of analytic capability across the customer life cycles are set out in slides 30 to 34. A specific example of how we use AI across policy life stages to manage persistency is presented on slide 34. This has helped us to increase persistency across all cohorts. The second element, diversified propositions, has been detailed from slide 35 to 37. Our company's strategy has been centered on continuously expanding the product portfolio to suit the varied customer needs. This enables us to cater to a wide range of customer spread across income segments, age, affluence, and other demographic aspects. Our endeavor to continuously innovate is exhibited through the 3 unique propositions launched in H1 namely ICICI Pru Gift Pro, iShield, and Protect and Gain. On the fund side, we launched Constant Maturity Fund, which was industry's first ULIP debt fund with constant maturity in H1 FY24. The details of the same are presented in slide 37. The third element, digitalization, has been detailed from slide 38 to 42. Across the customer life cycle, starting from policy purchase to claim settlement, digitalization has underpinned our journey. We have been working extensively to integrate our digital ecosystems with the central agencies to fetch KYC and income estimation details for customers' smooth onboarding experience. In September 2023, around 80% of our policies have been issued using digital KYC. Further, ICICI Pru Stack has enabled the company to issue 20% of the policies on the same day for the savings lines of business. Also, customers' income estimation can now be completed through digital integration of various documents such as through TOFIOS, GST, CAS, EPFO, Vahan and account aggregator. The fourth element, depth in partnerships, is presented on slide 44. We are committed to building long-term relationships and we continue to invest across channels by building existing channels and adding more distribution partners. Through ICICI Pru Stack, we intend to become the most partnerable insurer, and our partner integration team has the capability to onboard any new distribution partner in less than 2 weeks' time. Our strategy in the agency channel is to leverage on strong relationship with agents with their customers while we provide institutional support to agents in terms of data analytics and processes. We continue to build capacity by adding more than 18,000 agents during H1 spread across geography. Within the bank and non-bank channel, we continue to add new partnerships and increase the share of shop in existing partnerships. We have 40 banks and more than 1,000 non-bank partnerships with an addition of 105 non-bank and 1 bank partner during H1. We will continue to strengthen our distribution by onboarding additional partners and by investing in our own proprietary channels. Let me now talk about the business performance update through the elements of our 4P strategy. Starting with the first P, that is premium growth element, which is mentioned from slide 9 to 12. As you can see on slide 10, our total APE for Q2 stood at 20.62 billion, and for H1, it stood at 35.23 billion. Our retail business, excluding ICICI Bank, grew by 12.9% year-on-year in Q2, giving us the confidence that the business is on a growth trajectory. The headwinds we have faced in key distribution channels over the past few years have been carefully mitigated by the distribution diversification we undertook. We have no dependency on any single distributor, and we believe our diversified distribution mix will enable us to grow sustainably in the long term. While Anu spoke about the channel-wise growth, let me focus on the agency channel. A few years back, the agency business mix was skewed towards ULIP products, and thus the first step in this channel was about building capabilities to distribute multiple product categories to multiple customer segments. In the last 1.5 to 2 years, we started building capacity in this channel by scaling up the frontline managers who manage advisors under them. Additionally, we are investing in demand generation tools to expand the agent's natural market, and our analytics-backed digital product nudges are aligned to the right customer segments, which are the underlying segments served by our advisors. We continue to provide agents with institutional support, complemented by data analytics and digital capabilities to drive our business. Considering these investments being done, we expect the agency channel to contribute a larger proportion of the top line going forward. As you can see from slide 11, our APE from savings business stood at 16.72 billion for Q2. Linked saving products contributed 44.9%, non-linked savings products contributed 25.8%, protection products contributed 8.9%, annuity 6.1%, and group savings contributed 4.3% of the overall Q2. The non-linked AP mix has declined from 28.8% in Q2 last year to 25.8% in Q2 current year, whereas linked AP mix has increased from 41.1% to 44.9% in Q2 this year. One of the reasons for the shift in a mix is a significant proportion of more than 5 lakh ticket size non-par business shifting to linked and part guarantee products. And this trend has been increasing month on month in Q2 FY24. The annuity business has declined by 6.7% year-on-year in Q2, primarily on account of customer preference shifting to fixed deposits over single premium annuity products in bank insurance channels, given the attractive FD rates offered by banks. The decline in the single premium category has been mitigated to a large extent by the strong growth that we saw in regular premium annuity products during the year. We are well diversified in terms of distribution mix and product mix, which allows us to manage the impact of the external environment and respond swiftly to shifting consumer preference. Another important focus area for us is to serve the life protection needs of the customer. On this aspect, let me talk about the second P, which is protection growth, on slide 14. With an APE of 7.34 billion, the overall protection segment saw a year-on-year growth of 3.4%, leading to an APE mix of 20.8% in H1. Retail protection business, which had seen supply-side constraints in the post-COVID-19 era, has come back on track. The retail protection business has registered a strong year-on-year growth of 73.7% to 2.38 billion for H1. Our total new business sum assured stood at 4.9 trillion for H1, and our total sum assured stood at 31.67 trillion as on September 30th, 2023. We believe, given the current levels of under-penetration, retail protection business growth is a multi-decadal opportunity, while credit life and group term business also offer significant opportunities as we witness growth in credit and the economy. Coming to our third P, which is persistency improvement, is presented on slide 16. We believe persistency is the most effective indicator of the quality of sale and is a barometer of customer experience. This is reflected in the significant improvement in persistency ratios across cohorts. Our 13th month persistency ratio improved by 100 basis points to 86.9%, and our 49th month persistency ratio improved by 220 basis points to 65.8% for 5 months 2024. Now moving on to the fourth P, productivity enhancement, presented on slide 18. Our total expenses grew by 27% year-on-year for H1. This increase in new business commission is attributed to the redesign of our commission structure pursuant to the flexibility provided in IRDA Regulations 2023 issued on March 31st, 2023. The operating expenses increase is primarily on account of continued investment in capacity creation to support future growth. Our overall cost to TWRP ratio stood at 26.2%, and savings lines of business cost to TWRP ratio stood at 17.2% for H1. We monitor cost ratios for the savings line of business separately. Our objective is to bring in efficiency in the savings lines of business while we continue to focus on growth in the protection business. Our 4P strategy, together with our 4D framework, has been put in place by keeping in mind our core objectives of increasing the absolute VNB while delivering the value to our customers. I will now hand it over to Dhiren to talk to you through the outcome of 4P strategy and the financial update for H1. Over to you, Dhiren.
Thank you, Amit. Good evening. We regularly monitor our experience in respect of various risks, and the diligent and prudent risk management framework we operate on is reflected in our strong and resilient balance sheet as presented in slide 19. Our mortality experience is within our expectation. On the asset quality, 96.4% of our fixed income portfolio is invested in fixed income instruments that are rated sovereign or AAA, and we continue to maintain a track record of not having a single NPA since inception. Of our liability profile, 73.8% of liabilities largely pass on market performance to customers. We use derivatives to hedge interest rate risks in our non-par guaranteed savings and annuities portfolio. We continue to closely monitor our liquidity and ALM positions, and we have no issues to report. As a result of our 4P strategy, the VNB for H1 2024 was rupees 10.15 billion. Given our APE of rupees 35.23 billion, the resultant VNB margin was 28.8 for H1 2024. The shift in VNB margin is primarily on account of the shift in the underlying product mix towards unit-linked and the decline in the non-participating business. Coming to the financial update, Our profit after tax grew by 27% year-on-year from 3.55 billion rupees in H1 2023 to rupees 4.51 billion in H1 FY2024. As presented on slide 22, the adjusted net worth grew by 21.8% year-on-year to 95.66 billion rupees, and the value of in-force business grew by 16.8% year-on-year and stood at 289.63 billion rupees on September 30, 2023. With this, our embedded value grew by 18% year-on-year and stood at rupees 385.29 billion rupees at September 30, 2023. Assets under management stood at rupees 2.7 trillion, and our solvency ratio continued to be strong at 199.4% at the end of this quarter. To summarize, our financial strength, coupled with our diversified product distribution and customer mix, makes us resilient and allows us to take advantage of new opportunities in a fast-changing business environment. We will continue to make progress against the 4P strategy through our 4D framework. We expect that our performance in these aspects will translate into our objective to grow absolute VNB without compromising on our risk management approach. Thank you, and we are now happy to take any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah, hi. Thanks for the opportunity. Couple of questions. First one is on your shareholders account. If I see for the quarter close to 420 crores, 425 crores of investment income, and for the first half it's more than 750 crores. Roughly, annualized yield of close to 15% on shareholder investment. So, why such high probably investment gain booking? What is driving this? Is it coming from some equity or fixed income? So that is, and why sort of the trend is very unusual than your past? That's number one. Second one, on the margin profile, I do acknowledge that there is shift from, towards ULIP, and probably within non-ULIP, maybe some kind of a lowering of non-par guarantee towards par. But at the same time, if I see the most profitable retail protection has gained for the first half, if I speaking YOY, it has gained material share there. So somewhat it should have sort of an offset. Is it, also the margin is also a fact of, your costs, because the growth is not coming, but if you look at the commissions and OPEX also, both sort of have gone up. So is it also coming because of the kind of issues with cost absorption? And as far as, OPEX is concerned, you kept saying, the capacity building for future growth, but that is what, we have done for last few years, that we have been creating capacity to grow, but the growth has not been coming. So, what are the areas where still we need to sort of spend towards capacity building? Because, the growth has been slower. So, these are my two questions. Thanks.
Thanks, Avinash. So, on your first question of shareholder, yes, they've been able to use the markets to be able to realize some yields. The holding in the shareholder fund is not typically in line with what we hold for the policyholder portfolio, and so in this period we saw an opportunity to book some gains. That explains the heightened outcomes of those that line that we have. With respect to the margin, so Avinash, this is Dhiren. I thought I would just announce that. With respect to the margin question that you have, there has been a shift of the underlying product mix. Unit linked has grown. Within the non-linked portfolio, there has been an implicit mix between non-par as going towards par. That has had a part to play. You also have noted that within the annuity portfolio, annuity has declined. We spoke about the fact that there's been a shift away from single premium to regular premium annuities. But by and large, the overall annuity book also has declined. all of which has led to the shift in the product mix, which has resulted in the margin. You're right, we continue to invest in capacity building, and that capacity building outcome is quite visible when you look at the growth in business net of ICICI Bank, especially on the retail side. We saw that 13% growth. That clearly is an outcome of all the efforts that we've been making in stepping up our capacity and building out our distribution there. We will continue on this path because it's quite clear that we want to be able to keep our distribution quite diversified and not concentrated. To that extent, some of the newer channels that we have added, the newer distribution partners that we added, we continue to invest in those and build out the channel there.
If you can just help me, that your ex-ICICI Bank retail AP of 5.2 billion for the first half, what would be the contribution for, say, the top three in that?
So by and large, across my entire AP, we really don't have channels that contribute beyond 5%. If I take out ICICI Bank from a banker perspective, or I take out agency. No single distributor typically contributes more than the 5-6% range. And this would be the largest distributors outside of ICICI Bank.
So Avinash,
so if you look at the distribution, this is we set out in slide number 10. The mix is fairly clear. You've got agency at 25% for H1. You've got direct at about 14%. Banker net of ICICI Bank is at 15%. Partnership distribution at 14%. So if you look at this, it's fairly well diversified. We don't have large partnerships in the banker space.
Yeah. No, yeah, exactly. So, I was just trying to gather that, okay, within that 14.8%, if at all there is some kind of an indication around top three, because of course, you have a pretty deep banker partnership, but the banks are of different sizes and scale. So that's why I was trying to
also note that we've got close to 40 banks. That itself gives us a quite large enough spread.
Okay. Thanks.
Avinash, also, Amit Maita this side, if I could just add here, the protection impact you spoke about, while there is a very decent 70% plus growth on retail protection, but in absolutes, if you see, of the overall 35 billion H1 APE that we have, in absolutes, it still remains 2.38 billion, which is a very small percentage. So a very high margin on a low absolutes will have its reservation about compensating for a big shift that you may have on savings business. So that is just one point that I wanted to add and leave it there.
Okay, thank you.
Thank you. The next question is from the line of Swarnab Mukherjee from B&K Securities. Please go ahead.
Good evening, sir, and thank you for the opportunity. I have 2-3 questions. So I'll start first on the channel side. If you could explain, say the difference in how growth is panning out across different channels. Say, for example, in direct, what we are selling, which has resulted in such strong growth in the last couple of quarters, is it a base effect, or is that we are cross-selling more units, which is resulting in that? Vis-a-vis that, agency growth is yet to pick up despite the investments we have put in that channel. And on the partnership distribution side, what I am seeing is sustained growth momentum. So is it coming from adding new partners, or is it an organic growth that is happening? If you could give some color on these individual channels, what is driving these different growth trajectories? That is on the channel side. On the product side, if you could give us some color on how the non-par margin has been vis-a-vis what it was last year, given the shape of the yield curve and the availability of the hedging instruments that are there. And the fact that you have mentioned that there has been a shift in the non-linked portfolio from non-par to par, I was just wondering, we have launched a new product that is the Gift Pro product. How is the pickup in that, and whether it is compensating for some amount of, this move? These are the 2 questions on channels and products. And thirdly, a bookkeeping question, if you could call out the impact of economic variance in EV for the first half. Thank you.
This is Amit. So on channel front, let me just take the question. So you spoke about the fabric of our performance across channels. So first of all, let me just share with you On direct business, which comprises or proprietary business that comprises our agency and direct, constitutes close to 50%, 51% of our overall retail business. And on this direct business, which is showing a growth of 20% odd for quarter 2 and almost 23% for entire H1, is largely led by the upselling efforts that we make continually on our existing base. This is one channel which has really invested a lot on digital platform over a period of time and is one of the largest upsell channels in the industry. And this is not something which has happened now, but yes, the market sentiment, the buoyancy that happened on unit link has contributed to growth coming from unit link business across channels, and direct channel was no different. But also this channel is really backed with a lot of analytics on the next best product that can be positioned to our existing clients and is approached very systematically through our distribution team to offer most appropriate wealth solutions to our existing customers because of the changing life stage that we experience with our existing customers based on data that we have. One part of our direct business also is what we do through the traffic that we have of our customers on our website. So there is a lot of effort that has been taken in improving customer experience and also navigating and recalibrating our customer journeys based on insights that we pick up on our online channels. So that is also something which, in line with the overall ecosystem growth, support that we have on retail protection, has contributed to the overall growth in direct business. In partnership distribution, which is a combination of very, very diverse kind of partners on corporate agency and broker, has, an overall net impact which is positive. The overall business in this segment we have experienced has not grown at the partner level, but by virtue of our focus individually with our partners and by institutionalizing ICICI Pru Stack, which is a 7-layer support program that we have for our diverse partnerships, we have been able to work towards increasing our share over a period of last 6 months. And that increase in share has led to what you see here as a growth of 17.9% in partnership distribution. Coming to agency, yes, growth relatively is muted at 4%, but this is largely on account of what we saw in the month of September. If we were to look at performances right across May to August, we were seeing a good consolidated 15 to 20% kind of growth month on month. However, September, we do understand that this was one area that we could have done better. However, we are applying our analytics to see deep cohorts of our advisor segments where we can improve our performance going forward. But net-net, most of our diversified channels actually are on a growth path. That is the message that I wanted to give. Even bank assurance partnerships, other than corporate agency and broker, other than partnership distribution, right across, while the overall pie may have been constrained because of more than 5 lakh ticket sizes coming down drastically in the industry, but by virtue of increasing share and many of our bank assurance partnerships, we have been able to see a growth which is close to around 13% in quarter 2 and close to around 7% in H1.
Understood, sir. Very helpful. Just on the follow-up on the partnership distribution. So what I understand is that you were saying that it is basically a function of increasing counter share and not like any kind of additional inorganic growth that is coming through new partner additions, which maybe we have done over the last 6 months, which is now kind of becoming more productive. Would that be a correct?
We continue to add 70 to 80 partners almost every year. This year, in fact, we have added 100-odd partners. But as you know, there is always a gestation of new partners getting onboarded and getting to start business. So it is very difficult to figure out and single out only those 100 additions as to how much they have contributed. It happens over a period of time. So what you added last year has contributed to business this year, and what you probably added 2 years back has contributed relatively in a higher proportion. So if you ask me, is it because of new partners added this year which has contributed to growth? Answer is at this point in time, no. But it will pan out over a period of time.
So Adar, this is Dhiren. On your question on margins, through this year we have not seen any movement on margins on the non-par portfolio. So that continues the way it is. With respect to your question on economic variances, we have not broken the EV walk at half year. We will do that at the full year.
Can you give some color whether it is a positive or a negative impact?
It will be positive. It's quite positive. Given the way the markets have moved, it is quite positive.
Sure. And how is the pickup on the Gift Pro product? If you can give some, how should we think about this mix between par and non-par moving going ahead with new product launches?
See, what we observed going into quarter two and while exiting H1 is that large proportion of guaranteed products have started gravitating towards part guarantee, which has potentially higher upside if we were to deliver a good fund management performance on the participating products and on unit-linked products. So what we have seen is that a high mix of non-participating has moved some part into part guarantee as well as some part in unit-linked products. So to that extent, within a non-participating product, this Gift Pro was an addition, which cognizes the fact that customer is not probably looking only at IRR end of the day, but it also appreciates the features and benefits that we offer to our customers. So Gift Pro is unique in the sense that beyond IRR, it offers specific proposition to the customer, which addresses the specific need of inflation-adjusted income over a long period of time. That is something that we have seen as really a success. Of the 14% of non-participating business that we deliver as a company, almost 22% of this was Gift Pro in month one of launch, and today it is close to around 40% of our overall non-participating business. So we have seen this gravitating towards benefit-rich products and not really customer-yielding IRR-linked products. So that is something that we have seen as a trend.
Understood, sir. Very helpful. Thank you so much and all the best.
Thank you. The next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Yeah, thank you for the opportunity. I have two questions. So first is on the group protection side, you spoke about how the GTI specifically within group protection has seen challenges. So can you help us understand, given that GTI is like 50% of the entire protection, which is about 20% of your APE, can you help us understand whether this is an incremental drag on our APE targets that we've been speaking about, that we will be able to deliver industry level growth in the second half? Will this be a negative, or will this be a drag, or some color around this? My second question is on the performance in the month of September. So while I understand that you guys are trying to understand the performance of agency channel better in September, but can you give us some color on whether this could be because of higher drag from high ticket policies? Some of your peers have spoken about certain channels seeing more drag from high ticket policies, etc. If you can give us some color on how much drag you guys are seeing on high ticket policies and which are the channels which are getting more impacted, and could that be one of the reasons why September was weaker? That's it. Thank you.
Address this question on group protection. First of all, if I were to look at overall protection, you can broadly say the way contribution is, you can assume that 1/3 of it is retail protection, 1/3 of it is what you do on group protection on credit life platform, and 1/3 is what is group term for us. So when it comes to retail protection, we've already articulated it is close to around 74% growth for us. Credit life growth also is well ahead of the overall credit growth in the economy. That is largely on account of partners that we are adding over a period of last few months, and the effort to increase line of businesses within our existing partners, and also working on increasing attachment. So credit life growth also is well, and it is part of group protection. So to that extent, it is well on course. Coming to group term, we articulated that separately. Group term, as you know, for the large period during COVID and immediately after COVID, there was a time when ICICI Prudential was virtually present with a proposition to our clients for that period, and were one of the very few insurers who were quite prominent in our offering to our corporate employees, corporate customers. To that extent, we obviously had a very large base up for renewal, and hence what we have seen after the COVID experience turned out to be much better than what we had anticipated. The pricing went through a big correction subsequent to the experience turning out to be favorable. So it is good for the customer, good for corporates, but eventually it was not very good for AP. So if I were to share with you in terms of number of schemes and number of deals that we have closed as fresh new customers, actually there is a growth of almost 38% on the number of deals that we closed last year H1 against what we did this year. But however, the deal size in comparison to what was last year has actually come down significantly by almost 40 to 50%, which has led to overall AP looking suppressed. So we don't want to lose our sleep on this, because this is an impact of a better experience leading to a better proposition for the customer. In the interim, during the cusp period, we may have a little bit of a stress on overall AP, but that's fine. That's how it turns out, So we would not have it kept the price at a higher level when the experience has turned out to be favorable. So that is the color on group term. We are as much present in group term like the way it was earlier, and we are one of the largest players in this segment and understand it very well. And we will underwrite this business only if it matches our risk-reward expectations. That is something that we are very, very clear about. So even the cases which are coming up for renewal, they're coming up for renewal at a much lower price now. We are happy to offer it to our corporate clients as long as it is making sense, both from risk as well as profitability perspective.
Now, Shreya, on your question on September performance, while yes, on a YOY perspective, it seems low, but if I look at it sequentially, I think we're quite a divergence to the market. We've actually grown quite well compared to some of our larger peers, and actually had positive growth, which is not what most of the other companies have been at. So it's a little mixed bag when you look at September, but by and large, I think our clear focus is that we continue to work at it granularly and keep growing this business from month to month, quarter to quarter. In fact, our market share has been continuously increasing. It was actually 6.3% for the month of September on RWRP basis, which is higher than what it done in the previous period.
Okay, sir. So just coming back to my the last question that I'd asked. So our guidance on AP growth in second half at industry level, that gets challenged, right, because of group protection. That thesis is correct, or am I reading it wrong?
So, Shreya, we have not given a guidance on AP growth. I think what we have mentioned in our previous calls is that from a phase-wise perspective, step one would be to move the total AP growth in line with the market. We're not given a timeline to that. We want to get to that as soon as possible. And once we get there, step two would be to create an alpha over that. That's the trajectory that we want, but I'm not able to give you a timeline when we'll get there. But we've been working hard at getting to these objectives, getting to phase one first, and then to phase two.
Okay, sure. Understood. Thank you so much.
Thank you. The next question is from the line of Supratim Datta from Ambit Capital. Please go ahead.
Hi. Thanks for the opportunity. So I have three questions. Starting with the first one. You all have 1,000 partners now on the partnership distribution channel. So just wanted to understand, partners of scale are there, still which you could add in, to continue growing this channel. So that's one. The next question that I had was on the product innovation. So this year, in the first half, we did not see a lot of new products. But so going forward, in the second half, do we see, expect to see more product launches happening, and which segments would those product launches be targeting? And lastly, recently there was an article in the press talking about capping commissions for credit life policies at 30%. Just wanted to understand your views about, how, what kind of discussions are you having with your partners on, the commission structure post this new UM guidelines, which has been applicable from 1st April. Yeah, that's it. Thank you.
This is Amit again. So let me start with your question on partnership distribution with 1,000 odd partners. See, first of all, let me confess here the biggest advantage, natural advantage that we have with our partnership distribution is the diversity of partners that we have. So we have partners of very, very different, diverse types. Someone who's cross-selling to a captive customer base, multiple financial products, large partners. That is one cohort. Then there is a cohort which is essentially working on a POS model, looking at secondary distribution to reach out simpler propositions to their customers, coupled with some of the other general insurance products that they are selling. Then there are partners which are largely equity and mutual fund distributors who are also looking at life insurance as an upsell product. So what happens is this diversity allows us to play out in varying or a dynamic economic environment. So at any point in time, any environment, favoring any specific type of distributor helps us being at a natural advantage to take benefit of the positive tailwind there. And at the same time, we may have a disadvantage depending upon the kind of environment which may be impacting certain kind. Good part is that we have been net positive because there are some category of partners who are doing better in the given environment and some partners are getting impacted. But net positive is what we continuously keep working upon. If the environment favors, we get positive, and if not, then we work towards working deeper with our partners through our ICICI Pru stack, work on 7 layers of development, and work on increasing share. If the overall environment constrains the growth, then we look at increasing share to keep ourselves on a growth path. So that is how the partnership distribution outlook is, and that is what has kept us with a sustained growth over a period of last 4 to 5 years. If you were to place back performance of partnership distribution, this is one channel which has consistently grown at 25% plus over a period of last 4 to 5 years, just because of the kind of diversity that we have in our partnerships.
Got it.
So, Supratim, your question on product innovation, I think we've got this detailed out on slide 37 as well. And if I could just take a minute to refer back to slide 36, what you can see very clearly is that we've got products for every life stage across each of those opportunity segments. And the objective is to deliver value proposition to all of our customer pools. But specifically, if you look at innovation, there are 4 items that we have called out. One, of course, is the Give Pro that was launched this year. iShield is another product that we have launched. Protect and Gain is the 3rd product that we launched. And in fact, we've got a new fund in the form of a constant maturity fund that was launched during the year as well. So if you were to look at innovation, I think you've got enough examples of innovation on the product side that we've been able to demonstrate.
Jane, I was more interested in what is going to come in the second half. If you could give some color on that.
That is competitive information, Supratim. I can't divulge it. So, of course, we are at it. We keep picking customer insights, and there is always something which is WIP, and we're working on it. So, we'll let you know as soon as we launch those products.
Got it.
So, Supratim, on your other question on credit life, the way we're looking at commissions, of course, with the relaxation in commission levels that have been enabled by regulation, we'll keep working with our distributor to see what is the appropriate and sustainable level of commission through the year. That's what we had to add to this.
Just one follow-up. So are you seeing, a pressure from distribution partners for higher commissions, or is it still at a negotiation stage?
This will always be in WIP stage, Supratim, but you've seen some evidence of increased commissions across the board, across all lines of business, and it's not unique to us, it's across the industry as well. So yes, after the relaxation in commission levels, commission rates have gone up. Have they settled to a final equilibrium? I think not. It's still a bit of a flux at this point.
Got it. Thank you.
Thank you. The next question is from the line of Raj Sayya from Agam Capital. Please go ahead.
Hi, sir. Thank you. Just wanted to know your strategy in terms of Tier 2 and Tier 3 distribution and business contribution. Where do you stand currently and what's the strategy? Because we see that competitors, stress on this aspect. So just wanted to know. Please.
Yeah, hi, Amit this side. The Tier 2, Tier 3 strategy actually dovetails into our multi-distribution structure. As you know, if you were to look at the texture of our distribution, they have very good presence right across the geographies, across the country. When we look at our product structures, we look at affluence, we look at life stage, we look at geographies, and we keep turning out products which are most appropriate for the distribution channels who are present in those geographies. So to that extent, through our distribution partners, we believe that we are fairly representing tier 2, tier 3 markets today through small finance banks, small banks, new age banks, existing large banks, even to that extent of large banks like ICICI also has almost 40 to 45% of the distribution in rural. So to that extent, our presence in tier 2, tier 3 market has been there. If you were to look at agency, which is the most micro and diverse distribution structure that we have, 1/3 of our distribution in agency actually is in tier 3, 1/3 of our distribution is in tier 2, and 1/3 of the distribution is top cities. So to that extent, I think we are fairly well represented when it comes to tier 2 and tier 3.
Okay, thank you. Another thing, on annuity, I just wanted to know, do you diverge information on the split between corporate and retail annuity and what coming from NPS at this stage?
Raj, no, we've not broken that split out.
Okay, fair enough. Okay, thanks. That's all.
Thank you. The next question is from the line of Madhukar Ladha from Nuvama Wealth Management. Please go ahead.
Hi, good evening, and thank you for taking my question. First, on the GTI bit again, you mentioned that 1/3 is, so the total protection, 1/3 is from GTI, 1/3 is credit protect, and then 1/3 is retail protection. For what period is this? Is this for FY23 or is it for the first half of FY24? I understand that these are rough numbers. And, given the pressures that we are seeing in GTI in terms of pricing, how much do we really see this business growing in this year? If you could help us just get a sense of what sort of growth we could get here. And, even given the pressure in pricing, are we seeing also margins come off substantially over here? Is another question that comes to my mind. And frankly, I also know that the VNB development of the business that we had written earlier, are we seeing any negative variances due to this pricing pressure currently in this business? Are we seeing any negative operating variance over here? So on the GTI, these are some of the questions. And you mentioned that on the more than 5 lakh rupees ticket size, there is certain movement towards ULIP, and then you also mentioned another category. Can you just explain that? And finally, if you could quantify how much is the more than 5 lakh ticket size in the first half versus second half of last year, and how much have we done in the current year? That will also be helpful. Those are my questions. Thanks.
So hi, Madhukar. So at one level, the first question that you had is what is the period for? It's broadly for this current year, this 1/3, 1/3, 1/3. Your second question on GTI and the outlook on growth, I think we'd called this out earlier as well. Given the set of challenges in the market, given the increased competition, we are not looking at a growth out of this particular line of business, and we continue to seek to defend whatever business that we have and ensure that we deliver adequate profitability out of that business. That's something that we kept very clear. As we've pointed out earlier also, we are one of the largest in this group term space, and quite clearly we understand the texture of the customer that we have onboarded. We understand their mortality, and we will take on business only if it meets the risk-reward framework that we set out. By and large, I think margins on this continue to be stable. There are, of course, calls that we take when we look at where the business is at, but we're quite clear that we wouldn't want to write negative margin business there. In terms of where this stacks up, therefore, as variance, clearly there's one element of business which was written during the COVID period and in the later half of the COVID period, whose renewals at this point are obviously netted off for all the COVID loading. So that really has a variance element when we look at the EV walk, beyond which we're not really seeing any drop in mortality outside of that. You asked a question around the 5 lakh.
Just one thing on this. Dhiren, can you give me the GTI number for FY23?
GTI numbers for FY23 is slightly higher than this broad split that we had given out.
Okay.
What Amit was also referring to earlier when he spoke of the more than 5 lakh ticket size migration, one level of migration was towards unit-linked plans. The second migration is towards participating plans. Okay. And that was your question that you had asked.
Yeah. And if you could give us some sense on, what is the split between first half and second half of last year, and how much are we doing in more than 5 lakh rupees ticket size in the first half of this year?
Yes, so Madhukar, we've not called that split out, but I think the way we look at it, we do understand where the segments are at and what are the relative advantages of each of the propositions that we have got for below 5 lakhs and more than 5 lakhs. And we continue to build out those propositions through a variety of our new product launches for them. Let us see how that particular segment emerges through the year. But I think we're fairly clear that irrespective of whether it be a more than 5 or less than 5 lakh, the objective is to be able to build on growth and broad-base our customer segments. So we'll continue to work on that line.
See, Madhukar, this H1, Amit this side, H1 has been a story of two halves. Okay, the first half was impacted because of the preponement of demand that happened on large value cases in the month of March for obvious reasons. And the second impact was the fact that another story of wealth preservation around debt products and mutual funds went through a change starting quarter one. So if you ask me, that was the reason why quarter one impact was quite obvious and was visible. Eventually, for relatively lesser number of choices available on investments, part guarantee and unit-linked products is where the acceptance started growing while the markets were doing well, as well as part guarantee, as you know, since it's also a function of how well you manage your funds, and potential returns would be actually higher than what one can offer on guarantee platform. The preference started moving towards part guarantee products. Preference started moving towards unit link. If you ask me net as recent as last month, we have started seeing that more than 5 lakh cases more or less is quite similar to what it was last year. The only thing is it was all skewed towards one category of products last year. Now it is split between participating products, unit link products, and also some element of it still continues to happen on guaranteed products.
Got it. Thank you. That's helpful.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities Limited. Please go ahead.
Thanks for taking my question. Just one or two points. Any sense that you could give in terms of, the business trajectory at ICICI Bank, and, how do you see the second half playing out here?
Yeah, Amit this side once again. So ICICI Bank, as they have articulated their priority on focusing on protection and annuity range of business. On protection, ICICI is showing a growth of close to around 45% over last year for the first half. So to that extent, in alignment with what they have stated as their preferred approach, we are seeing a growth on that side. On relative degrowth, month on month, we are seeing on the overall AP coming down. So what it was close to around 35% degrowth in quarter one came down to 15% degrowth in quarter two. We'll have a base effect playing out in quarter three. We'll see how it goes.
Sure. And if I look at the overall VNB growth for the company, I guess obviously we discussed about the challenges in the first quarter or for the country in the first half. In the third quarter, when I really look at the the margin base for 9 months, I think it's still kind of a slightly demanding base. So in the backdrop of that, how do we really look at VNB growth for the year? I know you have a sort of a, plan for doubling VNB in a 4-year period, but, how do you really look at this year?
So, Nischint, we haven't put out a plan of doubling VNB. I think we were fairly clear that we want to build on absolute VNB as we go through this particular period. Yes, VNB growth has been challenged for the first half. It is down. But as we look at the base into quarter 3 and into early part of quarter 4, I think the AP bases are a little more benign, and we'd want to build upon those AP bases into the coming year. Quite clearly, what we've also spoken of is that VNB development would largely be driven by AP development, with some movement at the margin based on the product mix. So our key focus is to continue to deliver on growth. And as Amit pointed out earlier also, with some of our channels, we should start to see a more benign base going forward.
See, Nischint, also let me give you a context. If you were to look at overall distribution composition of ours, while all other businesses, whether it is partnership distribution, our direct business, our bank insurance business other than ICICI, they seem to be on growth path, and the large part of investment that we have done over a period of last year and a half or so is about creating enablement for our new partnerships, one, and two, about scaling up agency. And as you know, that agency scale up is a little longer and has a gestation period which we need to be patient and watch out for. Close to 4,200 odd frontline managers that we have who manage close to 200,000 agents, we still believe is a smaller number. And this is one area which has reached to this level only after having hired people over a period of last year and a half or so. Our experience, our analytics says that it takes almost 18 to 24 months for a frontline manager to start hiring, build capability with advisors, understand customer segments being served by advisors, understand their natural markets, build capability on demand generation, and eventually start turning out productivity. So our singular focus at this point in time, without diluting it with any margin pressure at this point in time, is to get our capacity to start turning productive. And that is where agency and our new partnership enablement will take primacy over anything else at this point in time.
On the partnership side, and as well as on the agency side, in terms of product profile, I believe, the initial thought was that, you'd probably focus more on traditional products through these channels, but, is there a change in the strategy, and are you also looking at doing ULIPs through these channels?
No, let me clarify, Nischint, we don't have a product to channel strategy just based on what we want. Actually, we allow our partners to choose based on the kind of customer segments that they have. So we have not mandated to our agency channel to sell only traditional and not ULIP because ULIP is low margin for us. It depends on the customer segment they're serving. So the approach that we have is simple. We decide on what customer segments we believe are priority segments, are the growth segments for us, where the quantum is. And then we identify which kind of distribution channel has the ability to take the right product and reach out to that customer segment. Now, if somebody has an access to an affluent customer, and if I control him and not get him to offer unit-linked products, it will be completely against the customer philosophy. So there is no channel which is mandated to follow any product strategy specific to traditional or non-linked savings or protection.
So, Nischint, as Amit also explained earlier when we had a question on partnership distribution, he explained about the various types of partners that we have as part of this pool. And you would have understood that there are different strategies that would follow for each and every one of these segments. So an equity broker segment, for instance, would have a slightly different approach than a more traditional broker that we have. So clearly the idea is to be able to marry the product with the customer segment and the distribution and create that product market fit that's appropriate for that particular segment there.
Actually, it is reflective of the fact that different distribution partners and within distribution partners, different cohorts and geographies and channels within channels actually have very, very different product mix. And in fact, none of the distribution partners have a product mix which is similar to what ICICI Prudential's overall product mix is. So the color of product mix is drawn from the customer segments of our partners.
Very much and all the best.
Thank you.
Thank you very much. Before we take the next question, we'd like to inform participants that in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one per participant. We'll take the next question from the line of Nidesh from Investec. Please go ahead.
Thanks for the opportunity. The retail protection growth has been reasonably strong. So can you speak about what is driving that? You mentioned that ICICI Bank growth is around 25%, which means that non-ICICI Bank protection, retail protection growth may be upwards of 100%. And what is driving that and sustainability of that? And also, post-COVID, we have changed the reinsurance strategy where we were retaining up to 1 crore of risk on our balance sheet. Has there any change in that strategy now?
So, Nidesh, let me take the second one first. No, we have not made a change in our retention strategy post what we discussed last. We continue to monitor the experience, and it's all within our expectation at this point. Growth within retail protection across channels has been quite strong. Overall, as you saw for the period, was about 84% for quarter two. Of course, this is on the fact that the last year's base was quite benign. As we go through into the coming quarters, specifically when you get to quarter four onwards, this should start to normalize back to more lower levels. But we'll continue to eke out growth across channels and keep it broad-based through the period.
So, is there any specific channel which has shown such high growth? Is it online channel, etc.? If you can give some color on that.
Yeah, so some of our online channels have done quite well. But we're seeing strong momentum across all our offline channels as well.
Okay. And just one follow-up is on the product level margins. How are the trends on product level margins on a YY basis?
So the shift that you saw in the overall margin has been obviously because of the product mix. That's been the large contributor towards movement in the margin. By and large, at the segment level, we've not seen too much of a change.
Sure. Thank you. Thank you, Dave. That's it from my side.
Thank
you. A reminder to participants to please limit your questions to one per participant. The next question is from the line of Vivek Kanoje from Aditya Birla Sun Life. Please go ahead.
Hi. So I wanted to know, you discussed about group term and group credit life. So wanted to know what is the growth story on the group funds for H1 FY23 versus H1 FY24?
Group fund for us is flattish, but we are fairly confident because these are lumpy businesses. We have done close to 550 odd deals have contributed to our group fund business this year, and a few large deals have got deferred, and we are not losing our sleep there at all because we are quite confident of what we have put as a plan for group fund business. It will pan out eventually in the remaining 6 months. So the number of deals, number of customers that we are engaging in is almost showing a 25% growth over the number of customers that we got our group fund participation last year. So to that extent, our distribution has been very strong, very vintage, and not just on group fund, but even on group term. We are fairly present right across, and our participation is among the highest when it comes to group fund and group term opportunity across the corporate sector.
Okay. Also, and on the annuity front, group annuity front, so the pressure from the fixed deposit. So do you have a growth on the group annuity funds from FY23 versus H1 FY24?
So, Vivek, this would all be part of the single premium annuity pool. Quite clearly, as we called out, a lot of folks are looking to defer single premium annuity given that bank FD rates are quite high at this point and competing rates at this point. However, we are seeing good growth come through on the regular premium annuity. And then we continue to push the regular premium annuity business at this point.
Okay, thank you.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, most of the questions have been answered. Just on the protection bit, what would be the share of ROP products, and could you highlight whether ROP products are margin dilutive for you with regards to the entire protection margins? And also, how is the ROP kind of moving, say, this year versus last year?
So the return of premium variant of the product is roughly about 15 to 20% of the retail protection business.
Okay, and from a profitability perspective, is it any different from the pure term?
It depends upon the tenure that you choose. So longer tenure gives you higher margins. Shorter tenure gives you lower margins there.
See, let me just share the fundamental that, propositions are not changing from non-ROP products to ROP products. It is only the customer behavior that decides whether he is okay to let go of a premium as an expense or he would like to take his premiums back. Otherwise, the underlying profile of the customer really doesn't change. We have seen this kind of a behavior more prominent in mass, but we have seen even affluent customers at times preferring the return of premium products and alternate products where they can get high covers with probably even a higher return of premium by choosing a high cover on a unit-linked platform. So from that perspective, margin really doesn't change by nature of ROP or a non-ROP, because underlying customer and the cover that you offer is quite similar.
Got it. Thank you so much.
Thank you. The next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good evening. Just one question. Are you seeing any change in payouts to any of your distribution partners or any of the select segments for this for any particular partner out there post guideline changes?
Dipanjan, yes, we discussed this earlier. We have seen commission rates rise for us, and understanding is this is not just specific to us, it's for the industry as well. Has it settled down? I am not so sure. I think we'll continue to work through this into the coming quarters as well.
Okay, sure. Thank you.
Thank you. The next question is from the line of Rishi Jhunjhunwala from IIFL Institutional Equities. Please go ahead.
Yeah, thanks for the opportunity. Just one question. I mean, even apart from commissions, if I look at other OPEX has gone up substantially for us on a 1H over 1H basis as well, whereas the premium growth, of course, has not been that strong. So just trying to understand, what is driving that X of commissions also. And in the backdrop of that, do you think that, given that seems like, a lot of these commission increase are going to stay here for a while, do you think that VNB growth in this year will be possible?
So, Rishi, outside of commission, some of the larger expense items are, of course, employee costs. Part of it is the capacity creation that we have invested in, and we continue to invest in given some of the newer channels that we've added on. There are, of course, some of the advertising and sales-related costs that are elevated at this point. Given that commissions are going up, we seek to kind of keep the overall expenses broadly where they are. This year, of course, will be a bit of a flux, so we'll have to manage it through this coming quarters to see how we can keep that stable at this point.
Also, I just want to clarify that while there has been a question on commission increase, but let me share with you that we are well within the guardrails and the direction given to us by the regulator in ensuring that we align our commission structures to promote long-term business, protection business, renewal business, and not at the cost of customer proposition. So since we have not let the customer proposition get impacted, for a short period of time, you are actually seeing that OPEX being swelling up. Directionally, this entire increase in cost need to get compensated through better OPEX management, and that is what we are intending to do. That is, the cusp period is where probably, it will take some time before it settles. But we are very clear that whatever is the increase in the cost, it will not come at the cost of customer proposition.
And so views on VNB growth this year?
I think let it emerge, Rishi.
And just on the commission part, right? So wanted to understand, you mentioned about, the industry is witnessing an increase in commissions. What are your thoughts in terms of how does that dynamic play out, given that, say, even for us, agency is proprietary, ICICI Bank is exclusive, and we have direct and group businesses as well, which are possibly, within our control. What kind of pressure is there for, commissions to be increased across the board, and what is the risk in case that wouldn't have gone up? Do you really think that the premiums would have severely gotten impacted, or the growth around that?
So, Rishi, the way we manage each channel is to look at the overall cost of the channel, for which commission is only one aspect of it. So, yes, this year is a bit of a flux. We've got other operating expenses that are slightly elevated. But on a steady state, the way we seek to manage each channel is to see whether for a product line that it finally delivers, whether the overall cost that it incurs is in line with what we would want to deliver from a VNB perspective. So it's a balance that comes through. I don't think this has impacted growth at all. Commission is essentially only one aspect of the overall spend that each channel does.
Thank you. The next question is from the line of Sanket Godha from Avendus Spark. Please go ahead.
Thank you for the opportunity. Just on the margin, if I want to draw a waterfall, the margin compression, how much you would attribute to product mix change and to the cost ratio? Whether the real problem is cost, which has dragged the margins, or is more the product mix? That's my first question.
Mostly product mix.
Oh, okay. And second, on cost, just wanted to understand, UM was expected to move the cost line items between commissions and advertisement, but it was expected to remain on the similar lines because, but still our OPEX ratio has moved up. But they just wanted to understand that UM is structurally increasing the commission cost and other expenses are not going to cut. And therefore, going ahead, we are going to see an elevated cost ratios, which could have an impact on the margins.
So, Sanket, like we mentioned earlier, this is a bit of a flux here. So, at that level, we're managing across these multiple line items. We're well aware that we'll have to keep overall costs in control to be able to deliver on margins.
Thank you. The next question is from the line of Neeraj Toshniwal from UBS India. Please go ahead.
Yeah, hi. Wanted to understand that this quarter looks a ULIP heavy for everyone. So what are the early trends you're picking up for the Q3 and going ahead? What we can expect? And are we okay to increase the ULIP share again back to a certain level, or we do have certain mix in mind that we need to kind of maintain to have a positive VNB by the end of the year?
So, Neeraj, I think we've spoken about this earlier as well. We are not guiding each channel to a product mix. If ULIP is the flavor of the season, we're quite happy to take that on board. Of course, they're quite cognizant that we're looking at delivering absolute VNB, and to that extent, we'll have to deliver additionally on AP as well.
Yeah, on that only, what are the trends you're picking up in other segments apart from ULIP? Can we see, because one of your peers called out that non-par savings possibly returning back, or might see a uptick from now. Are you also in the similar camp, or it's too early to call out?
It's a little too early to call out with this last 15-16 days. But as we mentioned earlier, we constantly are looking for propositions that could work with the various customer segments, even in the non-linked space.
So let me add here, like I have articulated earlier as well. Within affluent customer segments, we have seen a trend of a wealth preservation story which has been running so well over a period of last couple of years, giving way to unit link and part guarantee products towards the second half of this H1, which is a clear trend that is visible. Of course, it varies from partner to partner, and the composition of these customers at a partner level decides the mix of what kind of products we're selling there. But if you were to look at these set of customers eventually on our overall household that you look at the urban centers, these are only 10 to 15% of the overall number of households that you have. Almost 80% of the households actually are ranging between an income segment closer to around 300,000 to 25 lakhs. Means that there, the simplicity of the product and simplicity of the proposition actually takes precedence over any complexity or differentiation that you want to create. There, the demand for simpler propositions continue. And as you know, it is about our ability to reach out to these customer segments, identify which distributors have access to these customer segments. That degree of success is a function of, how we'll convert this opportunity on simple products, non-linked products, or participating products find its way into the overall product mix. That's how it will eventually pan out. There, if you ask me, trends have not changed drastically.
And how does digital stack will help us to achieve this goal? Can you elaborate more on that, which you have created a 7-layer stack, which you mentioned?
Yeah, so 7-layer stack is our thought process, our enablement framework for our partners. Over years, we have spent a lot of time in analyzing our own data as well as the data which is available in the ecosystem on understanding customers, on geography, on demographics, on income, on life stage. And we have really been able to segment the customers which are there in the market and customers which are part of the partner ecosystem. And based on the natural advantages of the customer segments of our partners, we have actually worked together and co-created value propositions which are most meaningful to their customer segments, and then convert those value propositions into a capability framework for their team, both on digital as well as non-digital platforms. And of course, we do believe that when it comes to life insurance, the best of value propositions and capability eventually need to be supplemented with demand generation model. And that is where our entire focus is to cut across all distribution channels to work exclusively on demand generation. Coupled with sales process integration and network integration with a partner, gives us the ability to onboard our customers, give them the experience, give partner the empowerment to manage the entire policy life cycle is what we have split as a 7-layer process for us. This is something that we are doing in a workshop mode with all our partners, and it actually changes partner to partner. And it's largely a function of the customer base and the primary model of business of our partners.
Thank you. The next question is from the line of Yash Jain from CNBC. Please go ahead.
Hello everyone, am I audible?
Yes, Mr. Jain, please go ahead.
So most of the questions which I had have been answered. One thing that I wanted to understand, and this is with respect to distribution, especially ICICI Bank. We have a setup where, your peers, the closest peers, HDFC Max, get about 50%, 60% of their APE from their main banking partner, that is Axis Bank and HDFC Bank. For us, it's come down significantly. It's kept coming down over the quarters. It's about 13.5%. Just last year, same period, it was about 20%. I have 3 very specific questions on this one. One thing, at ICICI Pru Life, do you have an intention to sort of increase your sales across product categories through ICICI Bank? If yes, then my second question is, are you doing something about it? Looking at ways in which this can be done, this will help the growth come back as well for the company. Just wanted the perspective from the management on this one.
Yeah, so Amit this side, Yash. So one principal partner philosophy that we follow across the new potential partners that we meet and the way we take up our partner stack to other partners, both with banks as well as non-banks, is to give the decision of what to do and what to propose to their customers, leaving that question entirely with our partners. We do believe that their brand is supreme, and we are subservient to, provide services in terms of manpower, technology, product to our partners. We don't play a role in influencing that decision because we do believe and respect the decision taken by our partners on what they believe is most appropriate for what they want to do and which fits into their overall scheme of things. To that extent, we appreciate that ICICI Bank does look at annuity and protection as two complementing products, which is not competing on investment space with banking. And we do appreciate that they prioritize banking products, they prioritize SMEs, they prioritize lending, they prioritize deposits, and we have complete appreciation for that. We'll take it as and when they have any priorities which are aligned to any specific proposition that we have in the basket. We'll be more than happy to offer and put it on table. At this point in time, we do see a value in what we have on offer, which is retail protection, and what they want as a proposition for their customers. And that's where we are seeing growth of 45% in retail protection with ICICI.
Okay, thank you so much on that one. One final question. I mean, since, earlier, you had one guidance on the VNB side, which was doubling VNB in 4 years. Under the new leadership, I just want to understand, is there one large guiding ambition in terms of quantification that you have, let's say for the next 2 to 3 years, for a slightly longer period that you would want the markets to look at and you would want to work towards?
So yes, Dhiren here. No, we've not put out a target as we've done earlier. I think what we're very clear on is that our objective is to work within each of our partners, look at it granularly, look at their customer segments that they operate in, and ensure that we've got appropriate products that can be delivered to those customer segments. And so to that extent, we would go deeper into each of those partnerships and, as Amit articulated, help them grow those particular segments using the partner stack that we just discussed. The idea is that if you're able to sustainably grow each and every one of the diversified channels that we have at this point, then we should be able to look at sustainable growth into the coming years. The fact that we don't have any large distributor outside of ICICI Bank in our distribution mix gives us the confidence that we're able to sustainably build out this particular pool of business by looking at it very, very granularly and looking at it with a deep lens of analytics as well. That is the core focus, and that's what we'll continue to work towards.
See, overarching theme which has been articulated over a period of last 6 months is a customer to product to right distribution channel who has access to that customer and taking the appropriate product. So customer to product to distribution is the overarching theme. And to support this theme is these 4D framework that we have created, which is power of analytics, data analytics, diversified propositions on product and taking it to diverse geographies and diverse partners, digitalization by making an experience which is differentiated for the customers, and eventually converting it into a depth of partnership, becoming an inspiration for us to come out with this 7-layer ICICI Pru stack to enable our partners. Eventually, the strategic direction is to become the most partnerable insurer in the industry.
Okay, thank you so much for taking both the questions and all the very best for each one and going forward.
Thank you.
Thank you. A reminder to participants to please limit your questions to one per participant. The next question is from Aditi Joshi from JP Morgan. Please go ahead.
Yeah, thank you so much for taking my question. So my question is on agency side, and I actually wanted to understand if we are targeting further increase in the headcount of the agents in the second half of this year. And I'm sorry if I missed it previously. I just wanted to understand what portion of this new agents are split between Tier 1 or Tier 2 and Tier 3. And just one more question, if I may. On the rider side, we have a pretty good, impressive suite of rider available to us. So just wondering that how much is the push from the management, or what is the strategy across the channel on increasing the rider attachment? Thank you.
Hi, Amit this side. On the distribution side, in agency, like I mentioned earlier as well, we are fairly spread out across all types of geographies, whether it is top cities, Tier 1, Tier 2, Tier 3, the way we spell it out internally. So we have a fairly distributed representation of advisors as well as our business the outcome as well as our advisor count is quite spread out across type of geographies. And on new acquisitions as well, new advisor licensing also is fairly in line with our spread of business. So to that extent, going forward, even in H2, I don't see that being different from what we've been following in agency for some time. Idea in agency is about the capacity that we have built to manage this advisor force, not just the existing ones, but also to acquire ones. And that is what, like I mentioned earlier, for some period during COVID, we had refrained from adding cost through capacity addition of frontline managers. That is something that we started doing some 18 months back. And that is something that we are going through a cusp period of building capacity there to manage our advisors better and improve efficiency and productivity over a period of time. I think they are in a cusp. It is expected to improve. And we want to accelerate it and try to cut the learning curve and reduce attrition so that we manage our advisor force even better. Coming to the second question that you had, which was on riders. First of all, riders, we don't see riders as an attachment product, first of all. So riders need to really add value to our customers and the proposition. We do believe that riders make our proposition very distinct in comparison to anything which is available across financial industry on the investment space. And accident or disability or critical illness add value. So from that perspective, the fabric of attachments are quite similar, which cut across health as well as accident and disability. And we would like to offer it as part of our protection as well as savings proposition. You know that these riders are not available standalone in the industry. And we want to offer it as a value add to our customers on the savings platform. And that is what we have been doing. Even on protection, we look at riders as a very specific strategy to convert our protection solution into a wholesome mortality and morbidity solution, which we offer through our flagship protection product, where the customer has an option to choose critical illness, accident ability, and actually both as well. Which we call it as an all-in-one proposition to give a most wholesome proposition on protection for the customers.
Thank you very much.
Thank you. The next question is from the line of Prateek Poddar from Nippon Asset Management. Please go ahead.
Yeah, hi. Sir, I have just one question. You called out about the kind of mix shifting, right, in the 5 lakh plus policy ticket sizes from entirely non-par to par or /ULIP. And then you also called out higher investments as well as higher commissions. In that backdrop, how should we think about VNB margins for the full year? Is it fair to say that given the mix shift we are seeing towards ULIP/non-par and the higher investments which you need to do because of growing your agency/other channels, margins would be under pressure this year, and next year is where, AP growth will be similar to VNB growth?
So, Prateek, Dhiren here. It's a little difficult to call. I think let it emerge through the year. There are, of course, product mix shifts that can emerge and that can drive where the margin would be. That will be one of the core components. Within which, of course, let us look at some of the expenses and see how we could manage them through this year as well. A little difficult to call. I think we'll look at the way the product mix evolves over the second half of the year. You anyway know that the larger portion of the business happens in the second half, so that can kind of dictate where we end up.
Okay. And you also talked about wallet share gains across some of the agencies, partnership distribution side and banca side, XI Bank. How much more potential is there for you to gain further wallet share, or bulk of the wallet share, whatever we could have done, has been done this year?
No, I don't think there's an end to wallet share as such. I think the key point is, while we look at wallet share as an outcome, I think the one clear thing is we're looking at how we're able to deliver value to our partners, and that's where some of the partner stack elements that Amit spoke of come into play. Right. The idea is that if we're the most partnerable insurer, then naturally we should have bulk of the business flowing to us. And that ends up as a higher wallet share. Because very clearly, as we spoke of earlier, we're looking at this product, we're looking at the customer, we're looking at the distribution channel, and each of those sub-segments are the ones where we have to ensure that we've got the highest, the best fit in.
And that naturally will give you the move towards our sets of products and our set of distribution rather than some of the other partners that may be there in the shop.
Sure. Thanks. Thank you.
Thank you. The next question is from the line of Sanket Koda from Avendus Spark. Please go ahead.
Yeah, thank you for the opportunity again. I have two questions. One, yesterday in ICICI Securities call, they also said that they are focusing on protection and annuity, which is very similar to what ICICI Bank is thinking of. So just wanted to understand how big is ICICI as a channel for us, and if they continue to follow the way ICICI Bank follows, what likely impact in near term will we have on the growth? That's point number one. And the second, honestly, the question still remains for me is on non-ICICI Bank channel, because the growth for 1H, if I look seems to be around 7% seems to be very weak. Is it largely driven because of the macro factors, because people are making more or putting money in deposits? It's macro related, or somewhere we are struggling with market share in the existing channels, and that is leading to some muted growth in the banking channel, non-ICICI banking channel.
Sanket, Abid this side. First of all, let me answer question on ICICI Securities. You're right. ICICI Securities also is looking at augmenting their proposition to their clients on protection and annuity. However, unlike ICICI, they are a very small part of our overall pie. They contribute close to around 2.5 to 3% of our business. And like I mentioned earlier as well, we allow our partners to choose what they think is most appropriate for their customers. I think we'll be more than happy, even if the top line is lesser and the protection is higher. It is value neutral for us. To that extent, that is fine. We appreciate and respect the decision and direction taken by securities, but they are a very small part of our overall business.
Got it.
Second, you spoke about overall growth momentum in non-ICICI channels, and let me just stitch it together once again. First of all, let me give you a number of 13% growth of non-ICICI in quarter two. So 13% growth is what you witnessed in quarter two. I did mention that loss of share was not the problem for us, because while the overall pie at a multi-insurer shop was severely impacted, more severely impacted because of guaranteed products becoming relatively unattractive in comparison to what was available in the H2 of last year on the regular ticket size, and also on large ticket size for obvious reasons, tax proposition. So all the multi-insurer shops were severely impacted because of this change in the environment. However, we still grew in partnership distribution by close to around 25% in quarter two. So this is largely on account of increasing share. Otherwise, the overall pie was almost similar or slightly lower than what it was last year. So this increase or this growth that you see in partnership distribution is largely on account of increasing share. And by the way, Sanket, let me also mention it to you that partnership distribution, what you see here, actually factors in ICICI Securities as well. So despite that 2-3% business that we have, which is part of our partnership distribution, having a change in direction actually did not have any impact on the overall partnership distribution growth, which still stayed at 25% for quarter two. Banker, very similar situation. Direct business, like I told you, both on online as well as upsell, we are growing well. Agency I've already articulated. We are still at a cusp stage. We are very confident that capacity will turn into an outcome for us very soon.
Got it. Perfect. Thank you very much for that.
Thank you very much. That was the last question in queue. I would now like to hand the conference back to Mr. Anup Bagchi, MD and CEO of ICICI Prudential Life Insurance, for closing comments.
No, thank you for staying back late evening. Thank you very much. Bye.
Thank you very much. On behalf of ICICI Prudential Life Insurance Company Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.